Hi, this is the Business Guy. So how do you give money, real estate, and other assets to your kids and minimize the inheritance tax bite? How does the gift tax work? Now, we set up trusts here for estate planning and asset protection, and we often have clients ask us to make their children the beneficiaries of the trust, not after they die, but right now. And we have to jump up and down and say, no, they can become beneficiaries after your passing. That is, make them secondary beneficiaries, but making them beneficiaries right now would likely be tax suicide. Ask your CPA. So first we'll look at the two categories of tax laws that deal with gifts and estates. Then we'll look at the annual gift tax and how to maximize the amount you can give to your kids each year. And then we'll take a look at maximizing your taxable estate upon your death. Then we'll talk about a special trust that we create called an AB trust that can double the amount a married couple can give to the kids no matter which one passes first. Let's take a look at two separate categories of tax laws that deal with the topic. One set deals with the gift tax before you die, and the other deals with the estate tax after you die. And while we're at it, please help me out by clicking the like button below so YouTube promotes this video. Thanks so much. And if you haven't already, you can also click the subscribe button below so that when more videos come out like this, you'll be up to date right away. Now, there are two sets of tax laws we're talking about. One set consists of the gift tax laws, and this applies to property and assets given from one living person to another. That's before you die, such as giving money to your kids each year, for example, below the gift tax amount, which we'll talk about in a minute. The second set of tax laws are the estate tax laws, and this applies to property and assets left to heirs upon death. It's a whole different set of tax categories, so we'll talk about how to get maximum benefit out of each during this video. So when you give assets to somebody, whether it's cash, stocks, or a car, the government may want to know about it and may even want to collect some taxes. Fortunately, a large portion of your gifts or estate is excluded from taxation. And there are numerous ways to give assets tax-free, including these. Using the annual gift tax exclusion, currently $16,000 per person per year. Now that's the current amount. And don't get so caught up in the amount, because the amount can change each year. You can Google that. I want you to instead really focus on the concept. Next is using the lifetime gift and estate tax exemption, which is currently $12.06 million after you die. Again, don't get caught up in the amount, get caught up in the concept because the amounts change each year. And finally, making direct payments to medical and educational providers on behalf of a loved one. In general, you might enjoy more pleasure when you give your assets to loved ones while you're still alive rather than when you pass away. Giving today allows your loved ones to benefit from your gifts right away and gives you the enjoyment of seeing the gifts improve their lives. In addition, these gifts can grow in value in their hands rather than yours, which may help reduce your taxable estate. How the gift tax exclusion works. Currently, you can give any number of people up to $16,000 each in a single year without incurring a taxable gift. So two parents together can give $32,000, and if the two parents are giving to their child and their spouse, that's $64,000. Let's take a look at this in review. So the father gives the son $16,000 in a year. The father also gives the son's wife $16,000 a year. So this is one person giving to one person giving to one person, and the mother does the same, $16,000 to the son, $16,000 to the son's wife. So that's one person giving to one person. So when you multiply that out, that's 16,000 times 4, you come up with a $64,000 gift per year. And that's tax-free. However, if your gift exceeds $16,000 to any person during the year, you have to report it on a gift tax return. That's IRS Form 709. Spouses splitting gifts must always file Form 709 even when no taxable gift is incurred. Once you give more than the annual gift tax exclusion, you begin to eat into your lifetime gift and estate tax exemption. With the passage of the Tax Cuts Jobs Act, the gift and estate tax exemption has really increased significantly. This chart we'll look at shows the current tax rates for the estate tax. You can see by this chart any amount given above the $12.06 million is taxed at a pretty steep rate. You can see this goes up to 40% tax, which is pretty significant for large estates. That's why it's important to maximize the amount you can give, and we'll talk about the AB trust that we establish for clients and other strategies we can employ to minimize your estate tax. Then another thing we can do is we can set up an LLC for you. You can control the LLC 100% as its manager. Then you can give $16,000 worth of membership interest in the LLC away each year. And by the way, you can give away cash if you like to, or just membership interest that you still control. Okay, now the $12.06 million exemption applies to gifts and estate taxes combined. Whatever exemption you use for gifting will reduce the amount you can use for estate tax. The IRS refers to this as a unified credit. Each donor, the person making the gift, has a separate lifetime exemption that can be used before any out-of-pocket gift tax is due. In addition, a couple can combine their exemptions to get a total exemption of $24.12 million. Now, there's a big warning to be aware of. The $12.06 million exemption might be just temporary and only applies to the tax years up to 2026 under the Tax Cuts and Jobs Act. Unless Congress makes these changes permanent after 2026, the exemption could revert back to the $5.6 million exemption adjusted for inflation. So here's the big question. If this new exemption disappears after 2026, how do you take advantage of it before then? How do you lock in this exemption? For the majority of people, the gift and estate tax exemption will allow for the tax-free transfer of wealth from one generation to the next. For those who have acquired enough wealth to surpass the gift and estate tax exemption, there are several strategies that could lock in the $12.06 million exemption. The simplest way is to gift some of your assets to your loved ones now rather than waiting until you pass away. Keep in mind, I said some. If you have the means, giving the assets now has two advantages. First, you get to see your loved ones benefit from your gifts. And second, the gifted assets could increase in value for your loved ones, and this could decrease your taxable estate. For example, if you were able to give the entire $12.06 million to your children today, that money could grow over time at a growth rate of 5% per year for the next 10 years. So that $12.06 million gift could end up being worth over $20.5 million, and your loved ones will have received the entire amount free from gift and estate taxes. On the other hand, if you held onto those assets and you passed away in 20 years, a large portion of the $20.5 million would be taxed at 40%. Additionally, in 10 years, the gift and estate tax exemption may have reverted back to the lower $5.6 million amount for dates after 2026, and that could result in your estate having to pay $5.9 million in federal taxes, leaving your heirs with about $14.5 million in assets rather than the $20.5 million if you made the gift sooner. Okay, now let's talk about ensuring the gifts are used and managed properly. One concern that many people have when it comes to giving assets away early is that sometimes the person receiving the gift may not be ready to handle the responsibility of managing such a large amount of money. A good example of this is a large amount of money gifted to a young child or teenager. One way to give those assets, but to ensure they are protected from misuse, would be to give them to an irrevocable trust and make the child or teenager the beneficiary. This method allows you to set the rules of the trust and determine how the assets will be invested and distributed. For instance, you could create a trust that stipulates the beneficiary can only have access to the income generated by the assets, or you could set up specific rules such as the beneficiary must graduate from college before having access to the funds in the trust. Now, there are numerous options when it comes to structuring a trust, and each state has its own rules. So if you're interested in learning about the various options available, take the time to give us a call and speak with one of our in-house attorneys. Now, the AB trust, as we mentioned, is another way to double the amount your children can inherit tax-free. So let's go ahead and take a look. How the AB trust works is like this. When the first spouse dies, the maximum amount that can be excluded under the estate tax exemption is left to the trust. So we have the first spouse's estate, and we have the remaining estate left to the surviving spouse. No estate tax due, and it's an unlimited marital deduction. That is, your spouse receives your assets, estate, and gift tax free. So when the first spouse dies, the assets are split into two pieces. One is the credit shelter trust, and the other is the surviving spouse trust. The spouse may have restricted access to the trust funds over here and has full access to the funds over here. So when the surviving spouse dies, all of the assets that were in this trust pass on to the beneficiaries. And then all the assets that were in this trust also pass on to the beneficiaries, doubling the amount that can be given to children estate tax free. So that's how the AB trust works and how it can double the amount you give to the kids estate tax free. And the law makes me say this. None of this is to be considered tax advice. This is for general information only. Your situation may vary, so see your CPA and feel free to call our on-staff attorneys for more information. Other ways to give tax-free. You can also make unlimited payments directly to medical providers or educational institutions on behalf of others for qualified expenses without incurring a taxable gift or affecting your $16,000 gift exclusion. This method is a great way to help out a loved one with large medical bills from an illness or to help pay for a family member's education. For example, say you wanted to pay your granddaughter's $50,000 tuition for her medical degree. You could pay the university directly for her tuition and still give her an additional $16,000 tax-free. And this strategy reduces your taxable estate and helps preserve your lifetime exemption. Okay, how to minimize taxes for recipients. One thing to remember about the assets that you gift is that your cost basis will transfer over to the recipient. So if that asset has appreciated in value significantly prior to the gift, the recipient could incur the substantial taxable gain while selling that asset. Highly appreciated assets that are received as part of an estate, on the other hand, generally get a step up in the basis price, which means a taxable gain could be avoided if the asset is soon sold after being received. So if a child inherits a free and clear house worth $1 million on the day that you die, let's say a year later, your child sells that house for $1.1 million. They only pay taxes on the $100,000 and not the entire $1.1 million. So with inherited real estate, they receive a step up in the basis price to the value on the day they inherited the real estate. A few more pointers. Lifetime gifting can be a great strategy as long as you leave yourself enough to live on. For the gift to count, it has to be a complete and irrevocable transfer. Okay, next this video focuses on the federal tax implications for gifting and estates. Depending on where you live, there could be state tax consequences for your gifts and estate. Now, to repeat, none of this is tax or legal advice. Before you take any action, take the time to meet with a CPA and estate planning professional to ensure your gift and estate plans are well thought out and properly implemented. As with any tax planning strategy, there is always a possibility that Congress could change the laws related to the gift and estate tax exemption. So you want to review your gift and estate tax strategy each year just to make sure your plans are still relevant based on your financial situation or changes in the tax laws. So I hope this helps. Please click like, subscribe, and share this video. Until next time, this is the Business Guy.